The Federal Reserve in the US is done hiking interest rates for this cycle. And whenever that has happened, it has historically always been cheered by stock markets by way of strong stock market rallies. And this time is no different. And it is so because stock markets tend to believe that Fed ending the rate hike cycle would mean that EMIs on home loans, car loans and business loans will stop going up. But that's a completely wrong interpretation, because the real reason why the Fed has to stop hiking interest rates is because by that time the economy is in such a weak spot that it simply cannot take the impact of any more rate hikes. In fact, historically it has always been seen that by the time the Fed is done hiking interest rates, it's just a matter of time before which the US economy would slip into the next recession, which would invariably be marked by a very large stock market correction too, not just in the US but pretty much everywhere around the world. And hence, ladies and gentlemen, Fed ending the rate hike cycle, far from being something that should be cheered, should in fact be treated as the inflection point from where the countdown for the next big stock market correction starts. Ladies and gentlemen, hi. My name is Indraneel Guha and I'm one of the co-founders of Metacaps.ai, which is an AI-driven personal finance platform. Ladies and gentlemen, we have seen strong rallies across most major stock markets around the world. Here in India, the primary stock market index, the Nifty 50, has rallied by a spectacular 30% over the last 1 year since March of 2023. Now, you see such strong rallies typically under two conditions. Firstly, when the markets are in the middle of a strong multi-year bull run, and secondly, when markets are drawing towards the end of a business cycle, when markets are making that final dash to that final blow of top, after which things starts to fall apart, after which the economy typically tips over into a recession and drags the stock market along with it. So where exactly are we? Are we in the middle of a multi-year bull run, or are we making that final dash towards the end of a business cycle? Well, that's exactly what we are going to examine during the course of this video. But before we do that, we need to understand the concept of something called the Fed funds rate, or the FFR. So what exactly is the Fed funds rate? Well, the Fed funds rate is the primary policy rate through which the Federal Reserve conducts monetary policy in the US. Well, that sounds like a lot of mumbo jumbo, right? Well, don't worry, I'm going to break it up for you. Firstly, what is the Fed? The Fed stands for the Federal Reserve Bank of the United States. It's the central bank of US. Like we have the RBI in India, it is the Central Bank of India. We have the Federal Reserve Bank, or the Fed in short, which serves as the Central Bank of US. The primary function of the Fed is to set the level of interest rate for the US economy, and it does so by setting the level of something called the Fed funds rate, or the FFR. When the Fed hikes the FFR, the effect of that is every other interest rate in the economy, be it the interest rate on home loans, car loans or business loan, all interest rates in the economy start to go up when the Fed hikes the Fed funds rate. And when the Fed cuts or reduces the level of Fed funds rate, the effect of that is every other interest rate in the economy, be it the home loan rates, car loan rates, business loan rates, every other interest rate in the economy starts to come down. So basically, by adjusting the level of Fed funds rate, by hiking or cutting the Fed funds rate, the Federal Reserve influences or sets the level of interest rate for the US economy. So this is how the Fed funds rate, the FFR, has moved over the last 20 years. As you can see, the Fed was hiking Fed funds rate in the early 2000s, and by somewhere around June of 2006, Fed funds rate peaked for the first time in this century. So we had a peak in FFR around June of 2006. Why does a peak in FFR matter? A peak in Fed funds rate matters because usually a peak in Fed funds rate means that we are drawing towards the end of a business cycle. And what is it that we get at the end of a business cycle? At the end of a business cycle, usually we get a recession, which basically means that once Fed funds rates peak, usually that is followed by a recession in the US within a certain amount of time. And that's exactly what happened back in 2006. We had Fed funds rate peak around June of 2006, and then within 1.5 years, from early 2008 onwards, the US economy witnessed a very, very severe recession. And as you can see, as the US economy was faced with a recession, we had the Fed cutting Fed funds rate very, very aggressively. The FFR started to come down at a very rapid pace. So why is it that the Fed started to cut Fed funds rate as the US economy was faced with a recession? Basically, the Fed starts cutting interest rates in the face of a recession in order to support the economy. Because when, as I explained a little while back, when the Fed cuts the Fed funds rate, there is a transmission of these rate cuts to across every other interest rate in the economy. When the Fed cuts the Fed funds rate, interest rates on home loans, car loans, business loans, everything starts to come down. So what the Fed is basically trying to do at the time of a recession is to cut the cost of capital, make it cheaper for people to borrow from banks. Fed is trying to basically encourage people to take a home loan and buy a house with that, take a car loan and buy a car with that, take out a business loan and maybe set up a factory using that business loan. Because when you do that, that is what helps create economic activity and ultimately helps the economy come out of a recession. And that's why during a recession, the Fed starts very, very aggressively cut the Fed funds rate. And that's exactly what the Fed did during the course of the recession of 2008 and 9. The Fed cut the Fed funds rate down to almost zero, and it kept the Fed funds rate at close to zero levels all the way till 2015. It was only from 2015 onwards that rates once again started to go up. And why did the Fed have start hiking interest rates from 2015 onwards? The Fed started hiking interest rates once again from 2015 onwards because things had started to normalize by 2015. Once again, we had demand for goods and services starting to go up once again from 2015 onwards. And that's why the Fed had to start hiking interest rates. But why couldn't the Fed have kept interest rates low even after demand had started to go up? Well, once the economic recovery starts to set in and demand for goods and services start to go up once again, you cannot keep interest rates too low for too long, because if you do that, you are basically encouraging people to take ever more number of loans and buy ever more number of houses and cars, and that can lead to an explosion in demand. And if you get a huge explosion in demand within a short period of time without a proportionate increase in supply of these goods and services, you will have prices spiraling out of control within a short period of time. In other words, you will get inflation. So basically, and that's why you need to start increasing interest rates in order to keep a lid on demand, so that demand can rise only in a orderly fashion. Because if you don't do that, then you will get runaway inflation during the course of a economic recovery. And that's why we see that from 2015 onwards, as things started to normalize, the Fed once again started to increase interest rates, and Fed funds rates started to go up once again. But as I also explained a little while back, once the Fed starts to hike the FFR, there is a transmission of these rate hikes to other interest rates in the economy. Home loans starts, the interest rate on home loans, car loans, business loan, everything starts to go up again. And ultimately, the brunt of that is faced by consumers and businesses who have to contend with higher interest expense on the loans that they have taken. And ultimately, as the Fed keeps on hiking Fed funds rate, we ultimately get to a point where it starts to dent demand. And as a result, demand for goods and services once again starts to slow down. And once the Fed senses that there is a slowdown setting in demand for goods and services, the Fed is forced to stop the rate hikes. And this is exactly what happened around January of 2019. For the second time in this century, Fed funds rate peaked. But usually the Fed funds rate peaking comes in at a time when by that time the damage is done. By this time, interest rates are already so high that for most consumers and businesses, interest rates are unviably high. So this is typically the time when you will see a big spike in consumers and businesses starting to default on their loans. There is a big spike in delinquencies, big spike in bankruptcies, and ultimately this is what paves the way for the next recession. And sure enough, the Fed funds rate peaking in January of 2019 paved the way for the next recession in US that started somewhere in early 2020. Of course, in 2020, we also got the COVID pandemic, and if anything, the COVID pandemic accelerated the rate at which the US economy descended into a recession. But the broad story still remains the same. This is how every business cycle pans out. First, you get a recession, and during the course of a recession, Fed typically cuts Fed funds rate very, very aggressively in order to stimulate demand. And as a result of these aggressive rate cuts, at some point in time, an economic recovery starts to kick in. And as and when an economic recovery starts to kick in, the Fed once again starts to hike interest rates in order to ensure that economic recovery doesn't lead to runaway inflation. But as and when the Fed starts to hike the Fed funds rate once again, rates ultimately get back to a level where they are completely unviable for most consumers and businesses. And this is what ultimately paves the way for the next recession. And as and when you get a recession, that marks the end of a business cycle. This is how a business cycle ends and a new business cycle starts. So this is how every business cycle plays out. This is not the story of just the last 20 years. You can go as far back as you want. It's been the same story all the way, almost going as far back as 1954. As you can see in this chart, I have gone all the way back to 1954. The vertical pink bars that you see are the periods when the US economy has experienced a recession. And each of these recessions has come on the back of Fed funds rate peaking. As you can see, Fed funds rate peaked here. It was followed by a recession. Prior to that, Fed funds rate peaked here, and that was followed by a recession. Prior to that, Fed funds rate peaked here. That was followed by a recession. So this is how you get a recession. You typically get a peak in Fed funds rate, and that is followed by a recession. Now, why does this matter to us at this point in time? It matters to us especially so at this point because very recently we have had Fed funds rate peaking in the US. In July of 2023, we had the Fed funds rate peak in US for the third time in this century. So clearly it's time to be very, very cautious because at some point in time, there's a very high risk that we could get a recession in the US. Now you might ask, even if we get a recession in the US, that's their problem, right? Why should we bother about a recession in the US? We are sitting here in India. Well, let me be very clear, a recession in the US matters for us and matters for us big time. Because whenever you get a recession in the US, that is usually also accompanied by a large correction in their stock markets. And the way stock markets are structured these days, whenever there is a large stock market correction in the US, the effects of that are invariably felt across the world, especially here in India. And this has especially been so since the early 90s when our economy and our stock markets opened up to foreign institutional investors. So since then, whenever we have had a recession in the US, that has led to a stock market correction in the US, and that has led to a correction of a similar order here in India as well. You don't want to believe me? I'll explain that with the help of one more chart. So what I've done here is I have added the blue line to this chart. The blue line is the chart which illustrates the movement of the Nifty 50 index. As you can see, back in June of 2006, we got the first Fed funds rate peak of this century in the US. That led to a recession in the US starting early 2008 onwards, and that led to a big stock market correction not just in India, but as you can see here in India as well, we got a 60% correction in the Nifty. The second time the Fed funds rate peaked in US was in January of 2019, and that paved the way for a recession from early 2020 onwards. But as a result of that recession, there was a big stock market correction, not just in the US. We also got almost a 40% correction, as you can see in this chart, here in India as well. So very clearly, whenever Fed funds rate peak in US, that paves the way for a recession there, and accompanying a recession, there is usually a large stock market correction in the US, and there is a correction of a similar order in our markets as well. So you can rest be assured that as and when there is a recession the next time in the US, the effects of that will be very clearly felt in our stock markets as well. So what should you do under these circumstances? If Fed funds rate has peaked, and we know that a peak in Fed funds rate invariably paves the way for a recession in the US, and we also know that a recession in the US is also usually accompanied by fairly large stock market corrections both in the US as well as in India, then should we just sell all our equity holdings and move to something more conservative like debt funds? Well, absolutely not. Because historically what we have seen is that usually there have been quite substantial lags between the Fed funds rate peaking and the stock market peaking. So what do I mean by that? So if you go back to what happened between 2006 and 2008, we had the Fed funds rate peak by around June of 2006. But the stock market in the Nifty in India continued to rally for more than 1.5 years after that. The peak in Nifty came in only by around January of 2008. That's 19 months later. The same thing happened in 2018 as well. The Fed funds rate peaked around December of 2018, but the stock market continued to rally for over a year after that. The peak in Nifty came in only around January of 2020. That's 13 months after the Fed funds rate had peaked. So there are substantial lags between the Fed funds rate peaking and the stock market peaking, and during these lags, the quantum of the rally that ensues is also quite substantial. So for example, after the Fed funds rate peaked in June of 2006, we got a 110% rally in the Nifty before stock market peaked in January of 2008. 110% rally means the market doubled during this time. And had you sold all your equity holdings in June of 2006 as soon as Fed funds rate peaked out of a fear that a recession is coming, then you would have missed out on this substantial 110% rally, right? The same thing happened in December 2018 as well. This time around, of course, the quantum of the rally was much less. And that was, in my opinion, because of the COVID pandemic. Because of the COVID pandemic, the rally that followed after the Fed funds rate had peaked was cut short because of the onset of the COVID pandemic. Chances are that if the COVID pandemic would not have been there, then this rally would have gone on for slightly longer. But even then, 13% rally is not insignificant, which is what we got after the Fed funds rate had peaked. Where are we right now? The Fed funds rate, as I mentioned to you, peaked in July of 2023, and since then we have seen a 13% rally in the Nifty, and this 13% rally, mind you, has come in just the last 7 to 8 months. So in annualized terms, it's a still higher rate of return that we have got from the Nifty. So as you can see, once the Fed funds rate peaks, usually after that there are substantial lags before the stock market peaks, and during this lag period we get very substantial rallies. So it's not a very good idea to sell all equity holdings as soon as Fed funds rate peak out of a fear that a recession in the US is coming. And by the way, there is a reason why you see we have seen historically such strong stock market rallies in the aftermath of Fed funds rate peaking. And the reason is that once the Fed confirms that it is done hiking interest rates, it gives rise to a sense of relief amongst market participants that the cost of capital won't go up any further. In fact, once the Fed confirms that it's done hiking rates for the cycle, it in fact gives rise to newer expectations amongst market participants that the Fed could well start cutting interest rates at some point in time, which in turn would mean that cost of capital could well start coming down. And this in turn gives rise to relief rally of sorts, and that's why we see such substantial rallies in the immediate aftermath of Fed funds rate peaking. But ladies and gentlemen, such a sense of relief is completely misplaced. As I mentioned to you a little while back, the real reason why the Fed has to stop hiking interest rates is not because they really want to make cost of capital lower for investors. The real reason why the Fed has to stop hiking interest rates is because by the time the Fed is done hiking interest rates are already unviably high for most consumers and businesses. As I mentioned to you, by the time the Fed is done hiking interest rates, usually what we have seen is that by that time the economy is already in a very tough spot, and demand is a very substantial slowdown in demand is already underway. But this is something that investors take time to realize. But ultimately the reality dawns upon investors that the economy is actually headed into a nasty recession, and that's the reason why the Fed has stopped hiking rates, and in fact the Fed will be forced to start cutting interest rates very soon. And once this reality starts dawning upon a critical mass of investors, a large number of investors ultimately start to panic, and that is when a material stock market correction starts to materialize. But I wish to reiterate once again, one should not be looking at a peak in Fed funds rate to time one's exit from the stock market, because as we saw historically, whenever the Fed funds rate peaks, usually in the aftermath of that we have seen very strong stock market rallies. But then that gives rise to the next logical question: if not a peak in Fed funds rate, what is then? Do we really have any other reliable indicator based on which we can time our exit from the stock markets? Well, I don't have a magic answer to that. There are a number of indicators that I look at. One of the indicators that I find quite reliable is the amount of balance that is left in the Fed's RRP facility. This is something on which I did a dedicated video about 2 weeks back. If you have not seen that video, please do have a look at it. I'll leave a link of that video in the description section. So one indicator that I personally find very useful with respect to predicting when the stock markets are likely to make a top and a correction is likely to start is when the Fed starts cutting Fed funds rate. Not when the Fed stops hiking Fed funds rate, when the Fed starts cutting Fed funds rate. But because usually by the time the Fed has to start cutting Fed funds rate, by that time the economy is usually in a very, very bad condition, and historically it has been seen that by the time the Fed starts cutting Fed funds rate, usually a stock market top happens very, very soon thereafter, and an equity market correction also starts within a very short period of time. This is what we saw back in 2007, 2008. So at that time, as you can see, the Fed started cutting Fed funds rate from September 2007 onwards, and the equity markets made a top in January of 2008. That's just 4 months later. So within just 4 months of the Fed starting rate cuts, the equity markets made a top and a correction started. Something very similar happened before COVID pandemic as well. The Fed started cutting Fed funds rate around August of 2019, and within just 5 months in January 2020, the equity markets also made a top, and after that a material correction kicked in. So as you can see, once the Fed starts cutting Fed funds rate, after that we need to become very, very cautious, because usually a recession starts very, very soon thereafter, and an equity market top also materializes within a very short period of time after that. Where are we right now? As I mentioned a little while back, in July of 2023, the Fed stopped hiking Fed funds rate. So there was a peak was formed in Fed funds rate. So far, they have not indicated, the Fed has not indicated when exactly they will start cutting Fed funds rate, but they have indicated that they intend to cut Fed funds rate about 3 times during the course of 2024. While nobody knows when exactly the rate cuts will start, most observers and analysts are of the view that the Fed will have to start cutting Fed funds rate by no later than May or June of this year. So if that really happens, then that is something that we have to keep a very, very close watch on. If we do get Fed starting to cut Fed funds rate from May or June of this year, at that point in time, we need to become very, very cautious with respect to our equity holdings, because going by historical precedents, as I just explained to you, usually a recession starts very, very soon thereafter, and an equity market top also materializes within a very short period of time after the Fed is done cutting, after the Fed starts cutting Fed funds rate. One more important thing, ladies and gentlemen, the timelines that I have discussed in this video with respect to the kind of time it takes for a market crash to materialize after the Fed has completed its rate hike cycle, or the kind of time it takes for a market crash to materialize after the Fed starts cutting Fed funds rate. These timelines are what have been witnessed in the last two cycles. There's no guarantee that a market crash in future will continue to materialize in line with timelines that have been witnessed in the last two cycles. The timelines in future could be more, it could be less. So that's something that you must bear in mind. Ladies and gentlemen, at this stage, I'll go back to the question that I posed at the beginning of this video. Are we in the middle of a multi-year bull run, or are we witnessing a kind of a rally that is typically witnessed at the end of a business cycle? So going by the contents that I presented during the course of this video, I hope it is abundantly clear to you that the kind of rally that we have witnessed over the last 1 year is clearly of the type that is typically witnessed towards the end of a business cycle. And hence, any suggestion that you receive from any market expert or any acquaintance to the effect that the kind of rally that we are witnessing right now is symptomatic of a multi-year bull run is something that you ought to be very, very skeptical of. Ladies and gentlemen, this brings me to the end of this video. I hope you liked the insights that I shared during the course of this video. If you did so, then please do like and share this video, and please do also consider subscribing to my channel. Thank you very much.